I'm Lynette Zhang, Chief Market Analyst here at ITM Trading. And what I'm about to show you is what I consider to be one of the best pieces and critically important that we all understand what's really happening. Because over the last 10 years, or since the financial crisis in 2007 and 2008, the QE money has been covering up a shift from longer-term assets to short-term funding of the entire global financial system. And I'm going to talk to you today about what that means. But the reason why it's so significant is because in funding, it's all about collateral. And bad collateral always chases out good collateral. So that means that what we're going to talk about today impacts your labor, your wealth, and our children's future. Because our good collateral will bail out all of the bad collateral that is now clogging our system. So that is what we're going to talk about today, friends, coming up. Welcome to ITM Trading. We are a full-service physical gold and silver dealer specializing in custom strategies to help you through this upcoming reset, and dare I say it, maybe even enabling you to be better off on the other side than you are going into it. Because hidden deep in the central bank's balance sheet that have grown enormously since the start of this whole trend cycle is that shift, like I said, to short-term wholesale funding, which means private, financial, or even non-bank entities lending money into existence, mostly to emerging markets. And then this collateral, the more they make of it, the less true value it actually has. So to start out with a couple of basics, and we're going to go through this, then what I'd like you to see is this neighbor working paper that I discovered on this very topic, and this is a fascinating piece. So I really encourage you to follow the links below and read the whole piece for yourself. Because what we're really talking about here, if everything is based on debt, that means that collateral matters. And what's been happening since the crisis is rise of a zombie firm. And I'm going to talk more about the zombie firms coming up and what they are. But I really want you to read these excerpts from this piece because over these last 9-10 years, the financial system has morphed from mostly insured retail deposit-based system, which you make a deposit into the bank, you're not going to put your money in and out, so you're not likely to run. And that is, and yes, there's more deposits in there now, but this has really shifted to those private firms. So it's morphed from a deposit-based system into a system with significant amounts of wholesale short-term debt, and that relies on collateral. And so in this new economy, and actually even in the current economy, and certainly when the next crisis hits, the quality of that collateral is going to matter. And we're going to look at what happened to that kind of collateral in 2008. But I want you to keep in mind that once enough risk has been transferred, that the central banks, and maybe that's what they were trying to do when they were raising rates so consistently into such a fragile economy, was attempting to trigger a recession to reduce that the fragility that is in the system right now. Because what they talk about in this piece, and honestly, I love when I come across the proof for this, because I've known this, we've talked about it many times, but the financial crisis in 2007 and 2008, and all of these crises, it's not oh my gosh, who should know? How could anybody possibly know? It's not just a freak thing, but it is a planned event that happens over time. So that was 2007 and 2008. Those vulnerabilities in the system have not been cleaned up. In fact, in reality, they have been expanded upon, setting up the next visible crisis. So part of what you need to be thinking about as we're going through the rest of these slides is, what collateral do I want to be holding when this next crisis becomes visible? Because we're already in the middle of it. This is not something we're waiting for. This is something that is already happening today. Because as I had said earlier, all of that central bank money printing and all of the money creation that was allowed by the major banks and non-banks, in other words, issuing debt, so creating money to existence. Well, look, they say that the economies are really strong. Well, frankly, then why is it when they attempted to slow down all of that money printing that magically we now have a global economic slowdown? Does that make sense to you? Because it doesn't really make sense to me. What it actually tells me is that what they did was ineffective. It didn't work. You take training wheels off of a bicycle. Well, when you put them on there, it was to teach that child how to ride a bike. And when you take them off, then they ride on their own. They tried to take the training wheels off of the economy after 10 years, and the economy is still falling down. And it doesn't matter whether it's Japan or China or Europe or the US or Great Britain or really anywhere in the world, we're seeing the same slowdown. And what tool do they have? Well, more debt, and interest rates are zero bound. So that means we've got to be going into negative rates. But I want you to think about all of the debt that they created to create all of these products. Essentially, there are 3 types of collateral. Number 1 is intangible fiat money collateral. So things like stocks and bonds and derivatives. So it could be a futures contract or a contract written against interest rates, but it is a contract as collateral. And any cash you hold in your bank, that's collateral too. It's intangible. You don't hold it, and therefore, if you actually read the underlying contract, you would see that you don't really own it. So how valuable is this collateral? Because this kind of collateral can be created at will. It's very cheap and very easy and very fast, and they create it based upon demand. So it gets destroyed when people want to liquidate, but of course you're assuming that you have the ability to sell. What we find is just like in 2008, when the crisis erupted, buyers dried up because it's a very narrow base of buyer, only used in one place, and that's in the financial markets. The second type of collateral are tangible assets. So that would be things like oil or real estate, real things that are tangible. But gold and silver, as far as tangible, assets and collateral are concerned, I think are the most superior because you can carry a lot of wealth in a small package and you can take it wherever you want in the world, and there's always demand. Silver and gold, particularly gold, has the broadest base of buyer because it's used in the financial system, but it's also used in manufacturing, in medicine, in electronics, in jewelry, in art, in food, in every single aspect of the economy. So there is always, always, always demand for physical gold and silver. Plus, gold is indestructible. It has never, neither one of them have ever gone to zero. Neither have any of the other tangibles like real estate or oil. Those have not gone to zero, whereas the intangible fiat wealth has a history of going to zero. And another area, key, so important area of collateral is you and your ability to work and repay those debts from the fruits of your labor or from savings that you have set aside or from the growth of equity in any investments that you have. So when you look at all three, because the only promise I can ever give you is that I will show up and I will do the work. So you get to enjoy the fruits of my labor. So it's a very key part of this whole collateral business. And in the intangibles, you can't make any guarantees because they're just contract based. So if they get a whiff of a crisis, they're going to run. That market will dry up in buyers. We need to keep that in mind. Because where we are in this trend cycle with debt levels so high, and we've talked about this many times in the past, debt has grown a whole lot faster than earnings have grown, which makes it challenging to repay that debt or roll that debt over, which means that if they can't do either one of them, you're looking at a default. And we're going to talk more about that in a second with the zombies. But there is a powder keg, because as people have been forced out on the risk spectrum, the savers, they have accepted a whole lot more risk that they do not understand that they're taking until, frankly, it's too late. So you have this mountain of debt that you use collateral for to get it, but then that is turned around and used as collateral to be able to take on more debt. And the more of it that's created in that way, it has market value because traders give it that value. But again, when there is a whiff of a problem, buyers evaporate, and therefore that evaporates. And yes, they can certainly go to zero. In addition, in a late cycle debt issuance, and this is all based upon collateral, you've got the grading agencies that show up again. And guess what? They give corporations wiggle room because they don't want to lower their credit rating and make it, because they can't afford to pay the debt that they have now, make it so that debt costs even more. That's why central bankers globally couldn't raise rates, because there's a massive amount of debt that's coming due. They can't pay the debt. Most of the corporations out there, many of them, cannot pay the debts they already have, let alone at a higher interest rate. So the whole system is between a rock and a hard place. And the grading agencies, just like they did in 2008, taking those subprime junk mortgages and making their magic on them and turning them into AAA rated assets that were infiltrated everywhere. Well, they're doing the same thing again. With corporations, they're giving these corporations that should be downgraded to junk, they're keeping them at BBB so that their interest rates don't go up. But what that's actually done is it's created zombie companies. Now, we're going to be talking more about this because we've got to look at Japan. And Japan in the early 90s was the first one to actually create those zombie corporations, even though that name finally came up in 2008. And what it means, what a zombie corporation is that the income that they have coming in before taxes and costs and everything else, the income that they have coming in annually is not enough to cover their interest expenses. And that has happened at least 3 years in a row. And because typically they're older, well-known names, well, them going out of business or defaulting on that debt, first of all, would be super visible. And if it's a weak bank, and basically, much as they tell you how shoring up they've done, their leverage is as high as it's ever been in the banking system. So, they're not as clean as they want you to think or as safe as they want you to think. But if they are a weak bank, they can't afford to have this major default. And so they just continuously roll over that debt, covering any excess costs or interest payment, which means the principal just grows and grows and grows. Now, you might recall that in 2009, when I looked at why we were servicing at that time $13 trillion in debt, when we were only running deficits of about $1 trillion only. But deficits of $1 trillion, it was because 77% of the debt that we were servicing was compounding interest. That means that's the same thing that's happening to these zombie corporations. And that's a doom loop. And if you haven't already, Megan put the link in to the video that I did on the 5 doom loops. I suggest you go back and view that one again. But that creates a doom loop between weak banks allowing these zombie corporations that do not have enough annual revenue to cover their interest expenses, let alone anything else. That allows them to appear okay. And with all the QE that the governments have done, where'd all that inflation go? It went all into those fiat money assets. So stocks and bonds and easy free money, which the corporations then use those inflated values to take on more debt. Starting to see the problem here? Because it's not real. It's smoke and mirrors that we're doing okay. And when something major happens, then it will be too late for you to do anything about. So a wonderful example that I came across was Steinhoff, who's been around since '64. It's a huge global conglomerate. They bought Mattress Firm in the US, so you might recognize that name. But they've been around since '64, and they're a very large corporation. The president used the Steinhoff stock as collateral for a loan. And at the time that he did it, he was only borrowing, 80%? He had a loan to value ratio of 120%. But then bad news came out, a shock came out, and the stock plummeted 90%. So that means that the value of that collateral collapsed. And it's only 24% of the loan now. If they defaulted, what do you think happens? And it's hard to see because they can use accounting gimmicks to hide it. So you really have to become a sleuth and do your own due diligence if you're going to be in a corporation like that. But you can't see it coming, so you need to get in position before something like this happens. Because I'd like you to look at the steepness of the decline, and you would not have known it, and you would not have been able to get out beforehand. And you would have been locked in that stock. So it is possible that contagion can spread when that happens to one major corporation, and it can spread throughout the global banking system because everybody's interconnected. Whether you are what they call a bank or whether you are what they call a non-bank. It doesn't matter. You need to be aware of this. This is really significant. And it's probably why central banks have been gathering high quality collateral, physical gold. And I'd like to point something out to you that you might not have realized, because here's 1971, here's 2008. Other than a few years in here, central banks have been selling gold to suppress the price or leasing it out. We don't really know how much any of them have. But you can see that in 2005, after that, they started selling less gold until by 2010. And this is by aggregate, so it'll vary from country to country. But in 2010, they started positively accumulating gold. And in 2018, their level of accumulation was second only to Bretton Woods in the 40s, when we were transitioning and the US dollar became the world reserve currency. And we promised to keep its value at $35 to 1 ounce of gold. Yeah, we didn't do that, did we? So I want you to stop and I want you to really think about the collateral, the valuable collateral that you want to hold into this crisis. Because if it's intangible, it's either going to lose all of its value or a chunk of its value, or freezing so that you have no access to it. And you can have a pretty statement that says you have that, but good luck doing anything with it. You can't take that to the store and buy strawberries or a loaf of bread. They're not going to care. So you need to make sure that whatever wealth you're going to hold in the system is, and therefore it's bad collateral because it can be hypothecated, loaned out over and over and over and over and over again by a whole bunch of different entities. It has minimal value in a crisis. So you want to make sure that you're balanced and you have the right amount of collateral to go into when this crisis becomes visible. Because if you wait until the crisis becomes visible, it's too late. You're not going to be able to do anything with it. And it's not because of the price, it's because you won't have any access. Because it's severely undervalued. It's definitely not about the price. Even if it were to jump up overnight to $5,000, it's still severely undervalued. And good luck getting your hands on it. I was here in 2008. Maybe some of you even remember trying to buy gold and silver in 2008 and being turned away because you couldn't get your hands on it because demand was so high. We were going out 3 months for delivery. Today, we deliver within 48 hours. That's normal. 3 months, non-normal. Last time in 2008, because we have long-standing positions and relationships with them, been around since 95, we were one of the few firms in the country that they were willing to what's called short. In other words, allow us to sell it even though they didn't have it in their physical possession yet. This time around, I'm pretty sure that's not going to happen. Last time they were reasonably confident that they were going to get it. This time there's an awful lot more gold and silver that is off the market. Look at the central bank accumulation and JP Morgan accumulation of physical silver. And all of us stackers that continue to accumulate. Well, we're doing what the smartest guys in the room are doing for themselves. And I think that's a really, really, really good thing. I don't care what the fiat price is. That's so easy to manipulate. And we all want to buy low and sell high. Well, right now, the only bargain out there is physical gold and silver. The monetary metals, shocker. Because a rising gold price is an indication of a failing currency. And if you realize the currency was failing, would you really want to hold instruments that are based on dollars and only pay you out on dollars? physical gold, and silver as well. But with gold, you can carry a lot of money in a movable, almost invisible packet. And you could go anywhere in the world with it. And bam, just like that, you can convert it into any kind of currency or good or service that you need, because it's global money. And that's why it is the single safest thing that you can do. And that's why it is the highest quality of collateral, because it's used across the broad market. So there's always demand. I suggest you look at this again. I suggest you follow the links and do your own due diligence on this, because the zombie implosion, look, some think that we could just have this really long slog like they have in Japan. So I'm going to do one in Japan and take a deeper look at that in the future, because we're trying to follow in their footsteps. Do you think this can go on forever with them just companies that cannot pay the interest on their debt, accumulating more debt and more interest? Do you really think that it can go on forever without consequence? Because I sure don't. I don't. I think we're at the end. I think all these unicorns getting out, this is insiders transferring wealth from you to them, because they're getting out while you're getting in. And I'm thinking they know more about what's going on with these unicorns than you do. So be smart. Even if you're going to do that, physical metals will properly diversify your portfolio. And I want you to really keep in mind that real shields are made of metal. And financial shields are made of real good money and good collateral. That's physical gold and silver, not paper or promises. So until tomorrow, where I'm going to show you some things about the farm, so to update you on where we're at with everything. But until then, please be safe out there. Bye-bye.